Assalamualaikum warahmatullahi wabarakatuh. Thank you for the opportunity. I'm from Group 2 want to present about the audit reports. My name is Muhammad Hafiz with name 657 and my friend Febriani Sarwinda with name 218. And next my friend Bertalia Permata Putri with name 440 and 40. Audit report. The audit report is the final result of the audit process, which is a report that states the auditor opinion regarding the appropriateness of the company financial statement, which are in accordance with the correct accounting principle in general. Standard unmodified opinion audit report for non-public entities. The auditor standard unmodified opinion audit report contains eight distinct parts. They are 1. Report title, 2. Audit report address, 3. Introductory paragraph, 4. Management responsibility, 5. Auditor responsibility, 6. Opinion paragraph, 7. Signature and address of CPA firm, 8. Audit report date. Condition for standard unmodified opinion audit report. 1. All statement balance sheet, income statement, statement of change in stockholder equity, and statement of cash flow are included in the financial statement. Number 2. Sufficient appropriate evidence has been accumulated, and the auditor has conducted the engagement in manner that enables him or her to conclude that the audit was performed in accordance with auditing standard. Number 3. The financial statements are present fairly in all material respect in accordance with U.S. generally accepted accounting principle of other corporate accounting framework. Number 4. There are no circumstances requiring the addition of an emphasis of meta paragraph or mere modification of the wording or auditor opinion in the report. Standard audit reports and report on internal control offer financial reporting under PCA OB auditing standard. There are two significant audit reporting differences for public companies. The first, the standard unmodified opinion audit report is different for audit of financial statement of public companies. The secondly, auditor of large public companies must also issue an opinion on internal control over financial reporting.
Okay, thank you for the time given to me. My name is Febriani Sarwinda with student ID 218. Now, in this slide, I want to explain about the unmodified opinion audit report with the emphasis of matter explanatory paragraph or non-standard report wording. Okay, as we know, the unmodified opinion audit report with the emphasis of matter paragraph are not standard report wording meets the criteria of a complete audit with the satisfactory results and financial statement that are fairly presented, but the auditor believes it is important to draw the reader's attention to certain matter or the auditor is required to provide additional information. In a qualified, adverse, or disclaimer report, the auditor either has not been able to perform a satisfactory audit, is not satisfied that the financial statements are fairly presented, or is not independent. And as we know that the generally accepted accounting principle require that the change in accounting principle or their method of application be to a preferable principle, and that the nature and impact of the change be adequately disclosed. And the maturity of a change is evaluated based on the current year effect of the change itself. An explanatory paragraph is required for both voluntary change and required change due to a new accounting pronouncement. The following are examples of changes that affect consistency and therefore require an explanatory paragraph if they are material. Like you can see at your slide that the first is about the change in accounting principle. For example, in here is such as a change from FIFO and LIFO inventory valuation. For example, that the first method that using by the company is FIFO, and then the company make the other method that is LIFO, like that. And the second change is change in reporting entities, such as the inclusion of an additional company in combined financial statement. And the third is correction of error involving principles by changing from an accounting principle that is not generally acceptable to one that is generally acceptable, including correction of the resulting error, change that affect comparability but not consistency, and therefore need to not be included in the audit report. For example, it will be following like this. First, change is change in an estimate, such as a decrease in the life of an asset for depreciation purposes, and the other so on. And then the other example is error correction not involving principle, such as a previous year's mathematical error, and then the variations in format and presentation of financial information. And the last, it should be changed because of substantially different transaction or event, such as new endeavors in research and development or the sale of subsidiary. Okay, now we talk about the report involving either auditor. Okay, the auditor's concern in such situation is the possibility that the that the client may not be able to continue its operation or meet its obligation for a reasonable period. The Financial Accounting Standard Board, or usually we call it FASB, recently clarified that management should consider the ability of the entity to continue its operation for a reasonable period, not to exceed 1 year from the date the financial statements are issued. And as we know that we use PCOWB, that the terminology to reference the different auditor responsibilities. When the CPA relies on a different CPA firm to perform part of the audit itself, the principal CPA firm has 3 alternatives. Only the second is an unmodified opinion audit report with modified wording. And okay, as you see in the slide that there are 3 alternatives. The first is about make no reference in the audit report. Why? Because when no reference is made to the other auditors, a standard unmodified opinion is given unless other circumstances required a departure. So this approach is typically followed when the other auditor audited an immaterial portion of the statement itself. The other auditor is well known or closely supervised by the principal auditor, or the principal auditor has thoroughly reviewed the other auditor's work. And the second alternative is make a reference in the report. This type or this alternative of report is called a share opinion or report. A share unmodified opinion audit report is appropriate when the portion of the financial statement audited by the other CPA is material in relation to the whole. And what is the last alternative? Let's say that the last or the third alternative is about qualify the opinion. A qualified opinion or disclaimer is depend on the materiality. Is required if the principal auditor is not willing to assume any responsibility for the work of the other auditor itself. Okay, going to the next slide. In this slide, we will talking about the modification to the opinion in the audit report. But first, there are 3 conditions requiring a modification to the opinion are briefly summarized, and each discussed in a greater depth later in this chapter. And like you see in the slide, that there are 3 conditions. The first is about the scope of the audit has been restricted, or the scope limitation. Okay, now we talk about the scope limitation. When the auditor has not accumulated sufficient appropriate evidence to conclude whether financial statements are stated in accordance with the appropriate financial reporting framework, a scope restriction exists. There are two major causes of scope restriction. The first is a restriction imposed by the client and thus caused by circumstances beyond either the client's or auditor's control itself. For example of a client restriction is management's refusal to permit to the auditor to confirm the material receivable or to physically examine inventory. And what is the second situation? The second situation is about the financial statement have not been prepared in accordance with generally accepted accounting principle or GAAP, like that. What is the example? For example, if the client insists on using replacement cost for fixed asset or values inventory at selling price rather than historical cost as required by generally accepted accounting principle, a departure from the unmodified opinion audit report is required. As we know that when US generally accepted accounting principle or like we say International Financial Reporting Standard or IFRS are referred to in this context too. The consideration of the adequacy of all informative disclosure, including footnotes, and is especially important, like that. And the last situation or the third is about the auditor is not independent. As we know that the important thing to become an auditor is we should have an independency in ourselves, like that. And how if the auditor not have the independency itself, independence ordinary is determined by the IECPA Code of Professional Conduct, the auditor independence requirement, and the IECPA code are further we will discuss in chapter 4, like that. And as we know that a qualified opinion report can result from a limitation on the scope of the audit or failure to follow generally accepted accounting principle. And a qualified opinion report can be used only when the auditor concludes that the overall financial statements are fairly stated. A disclaimer or an adverse report must be used if the auditor believes that the condition being reported on is highly material to the financial statement as a whole. Therefore, the qualified opinion is considered at least or the least several types of departure from an unmodified opinion audit report itself. Okay, next in this slide we will talk about the materiality. I think that you are already know, guys, what is the materiality itself. Materiality is an essential consideration in determining the appropriate type of report for a given set of circumstances. In this situation, is totally different when the amount are of such significance that the financial statement are materially affected as a whole. In applying this definition, there are three levels of materiality are used for determining the type of opinion to issue. What is the materiality? What is the level of materiality? Okay, you already see in this slide, guys, that there are three types. The first is amount are immaterial. The amount is immaterial when a misstatement in this financial statement exists, but is unlikely to affect the decision of a reasonable user. It is considered to be immaterial, like that. An unmodified opinion is therefore appropriate. And the second is about amount are material, but do not overshadow the financial statement as a whole. What the meaning of this kind of level? The second level of materiality exists when a misstatement in the financial statement would affect a user decision, like that. Sure, right? Okay. But the overall statement are still fairly stated and therefore useful. And for the next is about amount are so material or so pervasive that overall fairness of this statement. What is this, like that? I think that isn't a question the highest level of materiality exists when the user are likely to make incorrect decision if they rely on the overall financial statement. Okay, next. Based on this slide, when determining whether an exception is a highly material, the extent to which the exception affects different parts of the financial statement must be considered. This is called pervasiveness. A misclassification between each and account receivable affect only those two accounts and is therefore not pervasive. As misstatement become more pervasive, like the likelihood of issuing an adverse opinion rather than a qualified opinion increases. So, the following may affect user's decision and therefore the auditor's opinion in a different way than most misstatement. The first is transactions are illegal or fraudulent. As we know that, we can conclude that is there are many statement or many transactions that should be illegal and then fraudulent like that. So as a good auditor, we can make it different. We can differences about that. And then the second is an item may materially affect some future period, even though it is immaterial when only the current period is considered. The third, an item has physiological effect. What's the example? What's the kind of physiological impact? For example, the item changes a small loss to a small profit, maintain a trend of increasing earning, or allows earning to exceed analysis expectation. Okay, and then for the last is an item may be important in terms of possibility consequences arising from contractual obligation, and I think that for example, the effect of failure to complete with the debt restriction may result in a material loan being called. So I think that's all for me. For the next explanation will be explained by my friend. Thank you.
Thanks for the opportunity. Here I'm Berta with student number 440. Will continue the presentation. So here I'm gonna explain to you about the discussion of condition requiring a modification of opinion. So there are two major categories of scope restriction. It is the first caused by the client and the second is caused by a condition that are beyond the controls of the client or the auditors. So actually the effect of the auditor's report is almost the same, but the difference is slightly different in the interpretation of the materiality. So when there is a scope restriction, the good response is to issue a report with an unmodified opinion or a report with a qualification of scope and opinion or a report with a disclaimer of the opinion, and that is depend on the materiality. The two restrictions occasionally imposed by the client of the auditor scope relate to the observation of the physical inventory and the confirmation of account receivable, but other restrictions may be also occur. In the most case, when there is a condition beyond the control of the auditors and the client, it's usually caused by a scope restriction when the auditors is appointed after the client's balance sheet date. That's why the AICPA's account auditing standard requires the auditors to include a heading such as a basics for qualified opinion. Notice the headings preceding each paragraph when the amount are so material and the persuasive that a disclaimer of opinion rather than a qualified opinion is required. So, the first paragraph is modified slightly to say, we were engaged to audit blah blah blah. This first paragraph auditor's responsibility is modified to indicate that the auditor was not able to obtain a sufficient appropriate evidence to express an audit opinion. So here in this slide, I will explain about the audit decision for audit report. there are two decisions. The first is determine the condition. The second is determine the materiality for its condition. Determine whether any condition exists requiring a departure from a standard unmodified opinion report. So here the auditors identify this condition when they perform the audit, and they include the information about any condition for the audit file or a discussion for the audit report. So if there is no any condition exists like as the usual common case, the auditor will issue a standard unmodified opinion audit report. Next, the second is decided the materiality for its condition. So when there's a condition where requiring a departure from a standard unmodified opinion exists, the auditor will evaluate the potential effect on the financial statement. They decide the appropriate type of report for the condition given the materiality level after making the first two decisions. And it will be easy to decide the appropriate type of the opinion by using the decision aid. So here I will explain about the International Accounting and Auditing Standard. Currently in the US, the public companies are required to make a financial statement that are filed with SEC in accordance with generally accepted accounting principle in the US. The SEC itself has been working on plan to determine whether to incorporate the IFRS to US financial reporting system. The SEC from 2010 and 2015 strategic plan already suggests to the public company in the early 2015 to use IFRS, and for the most recent development, the SEC will be slowing down to embracing the IFRS in any time soon. They may engage to report the financial statement according with IFRS. So when the auditor reports on a financial statement prepared in conformity with IFRS, they are referred to the standard rather than to US generally accepted accounting principle. I already know that I already explained before in the last week that IAASB already issued an international standard on auditing. Now, the auditing standard in the US allow the auditors to report the financial statement of non-public entity using these two principles, US or the ISA. And the first paragraph of the auditors is modified to indicate that whether these auditors using the US standard or using the international standard of auditing. So that's all for our presentation from Group 2. Thank you for the attention and thank you for listening to us. If you have any question, don't forget to leave it in the forum, and stay healthy and good luck for everyone. Bye bye.